Welcome to the deep dive. So imagine the global financial system, right? This huge network, pipes moving money everywhere.
Hmm.
And suddenly, there are new tolls at every border. That's kind of the picture with these U.S. tariffs from 2025.
Yeah, that's a good way to put it.
Today, we're going to dig into a recent report that looks at the initial shock waves, how these tariffs are hitting investments, credit, and, well, how banks even manage risk now.
Exactly. And you can think of it in sort of two main ways. First, you have the direct U.S. tariffs on financial services crossing borders.
Okay.
And then there's the counterpunch, the retaliatory tariffs from others, like China and the EU, hitting back at U.S. financial products.
Got it. So the big question we're really tackling today is, how is this whole thing redrawing the map for global finance? What does it actually mean for businesses, for investments operating internationally?
Yeah, what are the real-world consequences?
Okay, let's dive in. Specifically, what's the immediate fallout? What are we seeing right now?
Well, right off the bat, costs are up. Pretty much any financial transaction crossing a border.
Any transaction.
Just about.
Yeah.
So think banking, insurance, asset management.
Right.
If they're dealing with foreign institutions for payments, transfers, investments, it's getting pricier.
Hmm.
These fees, they're like sand in the gears, slowing things down, making it all more expensive.
And I guess it's not just the financial firms themselves paying these costs, is it? This must be causing some real headaches for multinational companies just trying to do business.
Oh, definitely. If the basic plumbing for international trade gets more expensive, those costs, they tend to trickle down.
Makes sense.
And then you have the retaliation, and that's a whole other layer. China, the EU, they didn't just sit there. They slapped their own tariffs on U.S. financial stuff.
Like what kind of stuff?
Things like insurance services, certain capital market products, international bonds, equities, maybe. And we're already seeing the effects. The U.S.-China Business Council, they reported a 15% drop in U.S. investment in China, directly linked to this.
Wow, 15%. That's not small change.
Not at all.
So this isn't just theory. We're actually seeing investment flows shifting or stopping. That's got to be tough for U.S. companies trying to grow in, those big Asian and European markets.
No question. It disrupts everything. Established plans, growth strategies. They're having to rethink it all.
Okay. Now, you mentioned it hits different parts of finance differently. Let's maybe zoom in a bit.
Yeah, good idea. Each subsector faces its own unique challenges.
Right. Let's start with commercial banking. I can see how fees on international money transfers, remittances would hit hard.
That's a key one. Higher tariffs mean higher costs for people sending money home, for businesses financing trade, even just exchanging currency.
And loans, too.
Yeah, we're seeing pressure on interest rates for international loans if they rely on foreign capital, because that capital just got more expensive to bring in due to the tariffs.
And the report mentions big names, right? Like JP Morgan Chase, Citigroup. They're adjusting.
They are. What's interesting is the report suggests they're focusing more on their home markets, domestically.
Really? Pulling back globally?
Not necessarily pulling back entirely, but maybe shifting focus. And they're apparently putting a lot more effort into researching alternative financing methods, things that aren't so exposed to these cross-border tariffs.
Trying to find workarounds.
Suggest maybe a pivot, yeah, away from purely global, maybe more regional.
Okay, that makes sense. What about investment banking? Their whole world is often those big cross-border M&A deals.
Exactly. And these tariffs, they're definitely creating headwinds for them. We're seeing a slowdown in merger and acquisition volume, especially deals involving companies in different countries, particularly with Asian markets.
Because it's riskier, more expensive.
Both. The deals become more costly and they carry more risk now.
So the appetite for those huge international tie-ups might be shrinking a bit.
The report certainly points that way. And it makes raising capital harder, too, foreign investors. They're understandably more cautious with these extra tariff costs involved.
So what are firms like Goldman Sachs or Morgan Stanley doing?
Well, according to the report, they're leaning really heavily on market research now, trying to pinpoint opportunities that might be, safer bets, more insulated from all this trade tension.
It really sounds like market research is becoming absolutely critical everywhere.
It seems to be.
Okay, let's shift gears. Insurance and reinsurance. How are they getting hit?
The insurance sector has pretty significant exposure. Think about policies covering international operations, or the reinsurance market where insurers spread risk globally.
Right.
Tariffs on goods from, say, China or Europe. That means higher premiums for businesses with those complex international supply chains.
Because the value or the cost of the insured goods goes up.
Exactly. The underlying cost and therefore the risk associated with those goods has increased.
Okay.
And we're also seeing some instability in the global risk pools. It seems some foreign insurers are rethinking their involvement in the U.S. market because of the retaliatory tariffs on U.S. financial products.
So they're pulling back.
Some might be, which leaves U.S. insurers needing new ways to manage their own risk exposure. Imagine that pool of global risk shrinking a bit or becoming more fragmented.
Which, again, just highlights the need to understand this changing landscape. The report really stresses market research into not just financial risk, but geopolitical risk, supply chain weak spot.
Exactly. It's not just about the balance sheets anymore. Geopolitics, trade policy, they're directly tied to risk management now.
Absolutely. Okay, what about asset managers? They're managing global portfolios.
Yeah, they're grappling with more volatility. That's largely driven by the swings in exchange rates and commodity prices these tariffs can cause.
Unpredictability.
Right. And the higher costs for foreign investments, plus the constant threat of more tariffs, it's forcing a major rethink of global portfolio strategies.
So those carefully balanced international plans are being redrawn?
In many cases, yes. And guess what? Market research is again playing a huge role, trying to find potential safe havens, maybe in emerging economies less directly hit, and understanding the longer-term effects of these policies on global growth. We're even seeing more use of AI-powered predictive analytics in market research just to forecast the impact of tariffs on investment flows. That's relatively new.
Interesting. Okay, last one in this group. Private equity and venture capital, especially funding startups with global dreams.
They're definitely seeing a slowdown, particularly investing in startups aiming for rapid international expansion.
Why is that?
Well, the tariffs just make it more expensive and complicated for these young companies to operate across borders. So naturally, investors get more cautious.
So that global reach, which used to be a big plus for a startup, could now be a hurdle.
In certain sectors, yes, it could be. And the report suggests U.S. PE firms are focusing more on domestic opportunities.
Staying closer to home?
Seems like it. And doing much more detailed, granular market research to figure out exactly how these tariffs will hit their current investments and any potential new ones. Firms like Blackstone, KKR, they're reportedly tweaking their portfolios to match this new reality.
It's really striking, isn't it, how these big policies have such specific, different effects across the financial world.
It really is.
Now, the report also talks about offshore providers. That's a really interesting angle, the companies supporting the U.S. financial sector from overseas.
It is, and it's often overlooked. The U.S. system relies heavily on these offshore providers for a whole range of things.
Like what kind of things?
Oh, managing international investments, handling back-office tasks, processing payments, specialized consulting, even managing assets held offshore. It's a long list.
And the report names some key countries, right?
It does. India, the Philippines, Ireland. They've become major hubs. They offer cost savings, sure, but also specialized skills. Think data analytics, navigating complex regulations, even fraud detection.
So these providers are really woven into the fabric of the industry, and the report says they're more vulnerable now?
Precisely. Because they operate across borders, they're inherently exposed to shifts in rules, political tensions, and, obviously, trade policies like tariffs. Any big change can send ripples through this whole network.
Which brings us to the direct hit on operations and costs for the banks themselves. It's not just tariffs on finance, but tariffs affecting how finance operates.
That's right. U.S. banks, especially the global ones, use offshore providers for lots of operational stuff. Software development, customer support, risk management functions.
Okay.
If new tariffs or regulations hit those offshore regions, it directly disrupts things and drives up costs for the U.S. banks.
And the report gave an example with tech, I think, sourced from overseas.
Yes. Many U.S. financial firms rely on software or data systems developed in places like India. If tariffs raise the cost of components needed there to make that tech, well, those higher costs get passed along to the U.S. banks.
And the report actually put a number on that.
It estimated operating cost increases for many U.S. banks in the range of 10 to 18%, particularly in departments that rely heavily on financial technology and data analytics.
10 to 18%, that's a huge jump in expenses.
It really is. And it's not just the direct costs. The whole regulatory picture gets trickier too. Well, as regulations in those offshore countries start to adapt or align with these broader trade restrictions, it complicates the relationship between the U.S. firms and their partners.
More red tape.
Exactly. More compliance requirements, which adds cost to transactions and squeezes profit margins even further.
So navigating all this, it demands a much deeper understanding, not just of finance, but global trade, shifting regulations, which circles us back to market research. The report really hammers this home.
It really does. Because things are so volatile, regulations changing, tariff shifting good market research isn't just nice to have anymore. It's essential.
Absolutely indispensable, it sounds like.
Yeah, it helps firms anticipate disruptions, assess risks properly, and just generally optimize how they operate globally in this dynamic environment.
The report broke down some specific areas where research is vital. Let's start with supplier mapping and risk assessment.
Okay, this is crucial if you rely on offshore tech or back office support. Good research helps you identify and check out alternatives. Maybe in Eastern Europe, South America, Southeast Asia, places that might have more stable rules or better costs.
So it's about diversifying, not putting all your eggs in one offshore basket.
Precisely, spreading the risk. And good intelligence also flags potential problems in your current regions, maybe new labor laws, tax changes, geopolitical flare-ups.
You can react proactively.
Exactly. Adjust your strategy before things go wrong, keep operations running smoothly.
Another key area was cost and pricing analysis, understanding how tariffs mess with the bottom line.
Absolutely vital. You need granular research down to the component level for things like software, data analytics tools, cybersecurity,
Why so detailed?
so you can see cost increases coming. If you analyze global price trends for these critical inputs and forecast future costs, you can make smarter choices about your own pricing, negotiate better supplier deals, and handle any fee changes for customers more effectively.
And then there's regulatory tracking and scenario planning, staying on top of the rules.
Non-negotiable. The rules are constantly changing everywhere. Dedicated research teams track these shifts, country by country. That gives banks the latest intel to adapt their operations and compliance.
So they're better prepared.
Much better prepared. They can build more flexible supply chain models that aren't so easily knocked over by the next trade policy shift.
It's not just the supply side, though. How customers react matters too, right?
Absolutely. If tariff costs force banks to adjust prices for products or services, they need to know how customers might react.
So customer sentiment analysis, demand forecasting.
Exactly that. Good market research helps understand potential reactions to price changes. That lets firms tweak their pricing, their marketing, maybe even their service offerings. It's also key for keeping customers happy and loyal, even if costs are rising behind the scenes.
And lastly, the report mentioned using market intelligence for geographic diversification, finding new places to operate.
Yeah, as traditional offshore spots maybe get more expensive or uncertain due to tariffs, research helps find new promising markets.
Where might they be looking?
Well, the report suggests looking at places with competitive costs and maybe more stable regulations. It specifically mentioned exploring shifts or expansions into parts of Latin America, Central and Eastern Europe, and even parts of Africa where digital finance is growing fast. Maintain efficiency without being too exposed to tariff swings.
It's clear this whole environment is pushing financial institutions to be way more strategic, more data-driven globally. The report wraps up by looking at some actual responses, right? What are banks doing?
Yes, and it's fascinating. You see different strategies. The big players, like JP Chase, Citigroup, we mentioned them earlier, they're reportedly shifting some functions to lower-cost places like Mexico or Colombia.
As a direct response to tariffs.
Seems like a strategic move to mitigate the impact of higher costs on imported services and tech, yes.
And automation.ai, is that part of the response too?
Oh, definitely. There's a clear trend. More investment in automation, AI platforms. It's a way to rely less on outsourced labor, especially from regions hit hard by tariffs.
It controls costs.
And boosts efficiency. It's a double win, potentially.
What about smaller banks? They don't have the same deep pockets?
The report suggests they're often focused on finding new partners in offshore regions seen as lower risk, politically or economically.
So new alliances.
You're right. And diversifying their supply chains, maybe exploring regional hubs in Southeast Asia or Latin America, places with lower labor costs and maybe more stable rules. It's interesting. You wonder if they see a chance to specialize in niche markets the big guys might overlook now.
So it's a real mix of strategies, shifting locations, investing in tech, forging new partnerships. But the common thread seems to be adaptation and efficiency.
Exactly. And that big push towards digital transformation, more data analytics, blockchain, automation that's fundamental. These tools can really boost efficiency, cut costs, and help offset those tariff-related price hikes.
Well, this has been a really insightful deep dive. It's clearly a complex and fast-moving situation.
It certainly is.
To sum up, it seems obvious these 2025 tariffs are putting on serious pressure. They're reshaping strategies across the whole financial sector.
Hmm.
From the cost of simple cross-border payments to big shifts in global investment flows, the impact is everywhere. And it really sounds like sharp market research and being agile, adapting quickly,
Hmm.
that's becoming crucial for survival, let alone success.
That sums it up well. The global financial system is so interconnected, these tariffs aren't just isolated bumps. They cause cascades.
Right.
You really need a deep understanding of trade dynamics, shifting regulations, what everyone else is doing. It really makes you appreciate how tangled up the global economy is, doesn't it?
It really does. And that leaves us with a final thought for you, our listener. Given this incredibly complex web of global finance and trade, how might these tariffs eventually trigger consequences we haven't even foreseen, maybe unintended side effects? Or could they perhaps even create entirely new opportunities in the long run beyond just these immediate cost adjustments we've talked about today? Definitely something to ponder as this all continues to play out. Thanks for joining us for this deep dive.